Imagine walking into a bank and asking for $100,000. The bank approves you. You leave with a new balance in your account. But where did that money come from? You might imagine another customer deposited $100,000 yesterday, and the bank simply gave it to you. Sometimes banks do lend from existing funds, but modern commercial banking is more interesting than that. When a bank makes a loan, it can create a new deposit in the borrower's account. New money appears alongside a new debt. No truck carrying cash arrived, no vault opened, no pile of banknotes changed hands. A balance was created inside the banking system. This is one of the least intuitive features of modern money. Banks do not simply move money around. Through lending, they can create deposits, and that mechanism sits underneath a huge part of the modern economy.
The key is the bank's balance sheet. When the bank creates a loan, it gains an asset. The borrower now owes the bank money. At the same time, the bank records a deposit for the borrower. That deposit is a liability of the bank. One side of the balance sheet says, the customer owes us. The other says, we owe the customer. The bank has created a financial relationship, and the deposit can now be used. The borrower can buy a house, pay a supplier, hire employees, purchase equipment, or spend it on everyday goods. The money enters the economy through credit. This is why credit is so important to economic growth. It can bring purchasing power into existence before the underlying economic activity has fully occurred. But there is a catch. The loan must eventually be repaid, and that debt is very real.
If banks can create deposits through lending, why can't they simply create infinite money? Because banking is constrained. A bank needs capital. It needs liquidity. It must manage risk. It faces regulation. And most importantly, it needs borrowers who are willing and able to take on debt. A bank can approve a loan on paper, but the borrower still has to repay it. If too many borrowers fail, the bank absorbs losses. If the bank does not have enough capital, those losses can threaten its stability. So credit creation is not free money. It is a trade. The bank creates purchasing power in exchange for a claim on future repayment. That creates an extraordinary economic mechanism. The present can borrow from the future. A company can build a factory today using money it expects to generate tomorrow. A family can buy a home today using income it expects to earn for decades. A business can expand before it has generated the revenue required to finance that expansion. Credit connects the present to the future. Consider a mortgage. A house may cost hundreds of thousands of dollars. Most people do not have that amount sitting in a checking account. So the financial system creates a bridge. The bank provides credit. The buyer receives purchasing power. The seller receives payment. The house changes ownership, and the buyer spends years repaying the debt. The financial system has effectively pulled future income into the present. That mechanism has transformed modern economies. Without widespread credit, housing markets would look completely different. Businesses would have far less ability to expand quickly. Consumers would have fewer ways to make large purchases. Investment would become more dependent on existing savings. Credit, therefore, does something extraordinary. It changes the timing of economic activity. It allows tomorrow's expected income to finance today's decisions. But the same mechanism that accelerates growth can also amplify mistakes. When banks become more willing to lend, credit can expand, businesses can invest, construction can accelerate,
Consumers can spend, asset prices can rise, employment can increase, and economic activity can become stronger. This can create a powerful feedback loop. More credit creates more spending creates more revenue supports more borrowing creates more spending. The economy appears to accelerate. But underneath the expansion, debt is accumulating. That is not necessarily a problem. Debt can finance productive activity. A company can borrow to build something that generates future cash flow. A family can borrow to purchase an asset that provides long-term value. But credit becomes dangerous when borrowing grows faster than the ability to repay. Then the same mechanism that created expansion can create fragility, because every loan is also someone else's obligation.
Now imagine the opposite. Households become nervous. Businesses stop investing. Banks become more cautious. Loan demand falls. Asset prices weaken. Borrowers begin struggling with repayments. Credit expansion slows, and the feedback loop reverses. Less borrowing can mean less spending. Less spending can mean lower business revenue. Lower revenue can make debt harder to repay. And rising defaults can make banks even more cautious. This is why banking crises can spread so quickly. The financial system is interconnected. One balance sheet is connected to another. One institution's asset can be another institution's liability. One person's debt can become another person's income. The system creates efficiency, but it also creates interdependence, and interdependence creates systemic risk.
This explains something else: bank runs. If everyone who has money deposited at a bank suddenly demands it back, the bank may face a problem. Not necessarily because the bank owns nothing, but because its assets may not be immediately liquid. A mortgage can be valuable, but you cannot instantly turn thousands of mortgages into cash without consequences. A long-term loan is an asset, but a depositor wants their money now. This difference in timing is fundamental to banking. Banks transform maturity. They connect short-term deposits with longer-term loans and investments. Under normal conditions, that system works. But if confidence disappears, the timing mismatch becomes dangerous. People rush to withdraw. The bank needs liquidity, and fear can spread from one institution to another. That is why banking depends on something that cannot easily be placed on a balance sheet: confidence.
This is where our previous episode connects: the central bank. Commercial banks operate inside a larger monetary architecture. When liquidity disappears, the central bank can become a critical source of emergency funding under certain circumstances. The purpose is not to guarantee every loan. It is to prevent a liquidity problem from becoming a systemic collapse. This creates another layer of the financial system. Commercial banks create credit. Markets allocate capital. Payment networks move information. Central banks provide monetary infrastructure, and in crises can provide liquidity support. Different systems, different functions, connected together. That is why modern money cannot be understood by looking only at banknotes. Money is an architecture, and banks are one of its most important engines.
There is a deeper idea hiding inside all of this. Modern economies are built partly on promises about the future. A mortgage assumes future income. A corporate loan assumes future revenue. A government bond assumes future taxation or refinancing capacity. An investment assumes future value. Credit transforms those expectations into present economic activity. That is why confidence matters so much. If people believe the future will be stronger, they are more willing to borrow. Banks are more willing to lend. Businesses are more willing to invest. If confidence collapses, the opposite can happen. People protect cash. Banks tighten lending. Companies delay expansion, and the economy slows. The financial system therefore does something remarkable. It converts expectations about tomorrow into decisions made today. That is its power, and also its vulnerability.
The next time you see a number inside a bank account, remember what it represents. It is not simply a digital version of a banknote. It is part of a network of claims. A bank deposit, a bank liability, a payment instrument, and in many cases, the result of credit creation. Behind that number, there may be a loan. Behind the loan, there is a promise of future repayment. Behind that promise, there is an assumption about the future. And behind the entire system, there is confidence. That is why modern banking is so powerful. It can create purchasing power, connect present decisions to future income, finance businesses, build homes, expand industries, and accelerate economic growth. But the same architecture can create fragility. When credit expands too far, when borrowers cannot repay, or when confidence disappears, the system can move in the opposite direction. That is the paradox of modern banking. It creates money by creating debt. It creates growth by borrowing from the future. And it turns confidence into economic infrastructure. Money may look like numbers on a screen, but underneath those numbers is one of civilization's most powerful machines. NEXNET, the architecture of modern civilization.